If you're an Indiana teacher that has recently retired or is getting ready to retire, and you've built significant assets through investment accounts, and you want to make sure that your tax liability is the lowest it can be during your lifetime, this is the video for you. Today, we're going to navigate a specific tax strategy called a Roth conversion, how those can integrate with things like pensions and Social Security, and how to implement them so that you can pay less taxes over your lifetime and get in control of your money. Think of your accounts as two buckets. There's a tax deferred account where you never pay taxes on it, and there's a tax free bucket where you've already paid taxes and everything is tax free going forward. If you build significant assets in the pre-tax category, like a traditional 403b or traditional IRA or traditional 401k, those have never been taxed. Every distribution you take out will be taxed. And actually, when you turn either at age 73 or if you're born 1960 or after, age 75, the IRS will require you to take out a certain percentage of your account every single year. Those are fully taxable as well. And sometimes, without proper planning, those can be extremely high. And every dollar that comes out of those required distributions could be taxed at your highest rate. So we want to make sure that we're lowering those required distributions for later in life so that we avoid the tax bomb that could come from that. Today, I'm going to go over two married Indiana teachers, both retired, both 65, two pensions, two Social Securities. They've accrued a lot in their pre-tax category that without proper planning could cause them a lot of taxes. So we're going to explore Roth conversions and see if they're a good fit for them. My name is Evan Kaufman. I'm a financial planner with Kaufman Wealth Management. We help Indiana teachers build wealth. Okay, so as you can see on my screen here, we have Sean and Sally Sample. Now, these are obviously made up names for security purposes, but I'm going to go through this case study with you here. So we're talking about this year's taxes, 2026, and we have them married filing jointly. They're both over 65. Let's go through their income. Wages, they're not working, so it's zero. They're taking a little bit of money out of their account, about $500 a month. We're going to assume that's fully taxable. And then we have pensions. You see Sean has $2,000 a month coming in from INPRS, and so does Sally, $24,000 again. Social Security, we assume the same thing. Sean is getting $2,000 a month from Social Security, and so is Sally. This pays their bills. That's important here. We don't want to prioritize Roth conversions and have you not living life. So this is after all of their expenses and what they want to do. And now we have some room to play with. Before I want to get any further, I do want to show you this. It's based on what's called provisional income, which takes all of your income excluding Social Security. So in this case, it's their $48,000 of pension and there's $6,000 of IRA distributions. So call it $54,000 of non-Social Security income. And then they add back half of your Social Security income. So their provisional income is $54,000 plus $24,000. So at that point, their Social Security starts phasing in. Now, the maximum amount your Social Security can be subject to taxes to is 85%. And the way it gets up to that is if you make more income, your provisional income goes up. Every time your provisional income goes up, the higher percentage of your Social Security benefit is subject to taxes. So at this point with their income, their percentage Social Security taxable is 72.7%, meaning they have another around 12 to 13% of Social Security that could be taxed, but based on their current income is not. Now with Roth conversions, that does increase your income. So your provisional income is going to go up. I'll show you in a second what that looks like on our chart. But every dollar that you take, whether it's from your IRA to your bank account or your IRA to do a Roth conversion, every dollar you make, they're going to start grabbing more of your Social Security and making it taxable. It's kind of like a double taxation, which you'll see in a second. What if we increased our income by $1,000? What about two? What about three? All the way up to $250,000. And the way we can increase our income is if we go out and get a job. Well, we're retired, so that's not going to happen. We could get interest from a CD or the bank. We could take out of our investment accounts, or we could also do a Roth conversion. So that's kind of what we're modeling here, a Roth conversion. and what would be most beneficial to them. So again, this here on my screen, we're starting from 0 all the way up to 250,000. What's the tax on the first 1,000? 22.2%. Well, at their income level, they're at the ordinary income bracket of 12%, which you can see in that blue. But that purple, that extra 10.2%, that's what I was talking about earlier. The more you make, the more your Social Security is taxed, up to 85%. And so this purple drop off here, it's that extra 12 or 13% that wasn't taxed before at our old income, but now is taxed because we're increasing our income with Roth conversions. So that's kind of like a double tax, like I said earlier. And then after you fully max out your Social Security taxation at 85%, then it's kind of green pastures here. It's low brackets in that 12% bracket, all the way up until we reach $53,000. And at that point, well, then we start jumping into those high tax brackets, 22%. That's a 10% jump. And on top of that, you also are losing out on your enhanced senior deduction. If you're 65 or older, from 2025 to 2028, you actually get a $6,000 deduction for each person, so $12,000 total, if your income is below $150,000. Well, at that point, your income is actually starting to go over $150,000, and so that starts to slowly phase out, which is kind of like another tax. So we want to make sure we're avoiding that too. And this dotted line here, if you make too much money, well, now you're going to start increasing your Medicare premiums. So we want to avoid that as well. So where's the sweet spot? Well, depending on your situation, we'd probably do somewhere around a $50,000 to $53,000 Roth conversion. We are staying in that low 12% bracket, avoiding this 10% jump and phasing out the additional senior standard deduction. But keep in mind, we are increasing our Social Security taxes a little bit. But with that number, it allows us to take advantage of the low taxes without triggering anything higher. So now that we have our number, it's just paperwork. We sign a form, it moves from your traditional IRA to your Roth IRA. And there's a couple ways you can pay taxes. You can withhold it out of the conversion. So let's say that's a 10% tax, just to keep numbers simple, and you did a $50,000 Roth conversion. Well, if you wanted to withhold it out of the Roth conversion, you could convert 50, withhold 5, and what's received in your Roth IRA would be the difference, or $45,000. And then that would grow tax-free for the rest of your life. Or you could withhold no taxes and then just settle up on your return or pay an estimated tax, whatever you'd like to do. But really, we want to make sure that we're getting the most into that Roth bucket, so not withholding would be the best appropriate decision. I hope that case study can help you visualize the benefit of a Roth conversion, what to look out for, making sure we don't over-convert, keeping in mind Social Security taxation, Medicare premiums, higher tax brackets, phase out of different deductions. Obviously, this gets very complicated very quickly. So that's where a financial professional comes in, like ourselves. Here at Kaufman Wealth Management, that's a yearly thing that we do. Taxes are a real bill. We want to make sure they're as low as possible. So if you're curious about your own situation, your own income, your goals, objectives, what investment accounts you have, or if it's even worth to do a Roth conversion in your situation, give us a call. We'd be happy to help. We do this all the time. We do offer free consultations, so no obligations there. Once again, I'm Evan Kaufman. I'm a financial planner with Kaufman Wealth Management, and we help Indiana teachers build wealth.